Thanks for joining David and I. Today we're going to look at what individual investors can learn from institutional investors. We're going to break it down into five general points and areas. Institutional investors are made up of foundations, endowment, pension funds, and asset managers. There are many things that institutional investors do well, and we're going to look at what they do well and some of the things that individual investors don't. David, why don't you start with the first point, setting up an appropriate asset allocation?
That's right, Harry. Ensuring that you have the correct asset allocation is critical to getting the investment returns that you desire. Institutional investors like pension funds and endowments are very good at asset allocating, meaning apportioning a certain percentage of their portfolios to various asset classes like stocks, bonds, real estate. Part and parcel because they have very defined mission statements, or they have institutional investors have very defined purposes for what they're investing for. Take, for instance, a pension fund. Pension funds are investing on behalf of all the pensioners, both who are retired currently and who may be retiring in the next 10 or 15 years. And so the pension fund investors, the institutional investors investing money for the pension fund, know specifically how much income they need to pay out month to month and year to year, and they can forecast that into the future. And because they have very defined numbers in mind, they can allocate their investments to different asset classes quite specifically based on what they need to achieve to fulfill their mandate. And what a lot of individual investors fail to do is really discern what it is that they're investing for and to set up a strategic asset allocation that will meet their needs. So for most individual investors, they're not a whole lot different than a pensioner. They, will accumulate a portfolio and eventually want to draw an income from it. And so as an individual investor, you also need to be tuned into what your asset allocation is in terms of stocks, bonds, real estate, and how that portfolio is going to produce enough income to meet your needs in retirement. Another thing that institutional investors do well, Harry, is that they're diversified.
David, that's correct. One of the things institutional investors do is they're great at diversifying their assets. Now, some of these institutional investors, whether they're pension funds or endowments, they are enormous. I mean, billions and billions of dollars. And in some instances, they own whole companies worth hundreds of millions, and in some facts, even billions of dollars themselves. But one of the things that they do really, really, really well is they diversify their assets. So they don't put all their eggs in one basket. They would never take that type of risk inside their portfolio. So they spend a lot of time analyzing the profitability of every underlying asset, but also making sure that they limit their risk by not over-investing in any one company. And that's one of the mistakes that we do see on individual investors. And there's two folds with that. Number one is sometimes they overinvest in one company. They get a favorite and they put too many eggs in one basket. And if that one basket doesn't perform particularly well, they can cause some serious problems inside their retirement plan. The second thing is they believe their knowledge is better than it really is. And it's the old adage, if they have a little knowledge, sometimes you can get yourself in trouble. We see this with individual investors where they don't really have all the information that they need to make on it, but they get excited about something they read. And then again, they overinvest in a singular asset that doesn't give them the diversification or security that they do need. The third thing that institutional investors do really well is avoid making wholesale changes to your portfolio out of fear and emotion.
That's right, Harry. Institutional investors are very good at not letting their emotions or fear dictate how they invest money on behalf of their endowment or their clients. There's a couple main reasons why that's the case. Number one is that most institutional investors aren't managing these massive portfolios independently on their own. Typically, there's a committee of individuals, sometimes dozens and dozens of investment professionals whose opinions are all being accounted for when making investment decisions. So you're not getting any one individual's cognitive or behavioral biases swaying the decisions, and you're getting a whole lot of knowledgeable people coming to the correct decision more often than not. The second reason that institutional investors don't make wholesale changes out of fear is partly because they just really can't. Their mandates kind of preclude them from making wholesale changes. A great example is pension funds. As mentioned before, pension funds have to pay out a regular income stream to their retirees, and also plan for future income for people who aren't yet retired, but who may be retiring next year, 5 years from now, 10 years from now, 20 years down the road. And so what they have to do is, even though they may have suspicions that the markets may be due for a bit of a correction, they're never going to move their whole portfolio to cash, because they can't do that in good faith, because it's not going to meet their mission statement. If the whole purpose of the institutional investors running pension funds is to produce income now and into the future to meet the obligations of the pension, they can't in good faith move their whole portfolio to cash that doesn't produce adequate income to pay those pensions, because it's not a sustainable long-term solution. So they understand this, and they understand that certain assets like real estate, like stocks, like bonds, are all going to have ups and downs through different market conditions, but they plan for that, and they've got enough reliable, sustainable income to go through different markets and still be able to allow to pay for that income for the current retirees, and allow for enough growth to take place in the fund to continue paying an income for the next 20, 30, 40 years for all the future retirees too. The fourth point that institutional investors do well, Harry, is that they avoid unsustainable spending.
That's another great point, David. Unsustainable spending is definitely a problem that we see with individual investors. But let's look at how institutions do it first. As you mentioned before, most of the institutional investors, they know what their income needs are going to be because they plan for it. So there's no surprises. They know that they have the pensioners that need a steady income that are coming in. So they know exactly what they're going to how much money they're going to have to put out each and every year. And because of that, they invest their money accordingly. And they make sure that they only take out that amount. Unlike individual investors, which can come in and take out money at any time, pensionable people can only take out money based on their pension. So there's no room for them to take out extra money. Now, endowment funds do have a little bit more of a problem because they can take out a little bit more money at times. But again, these are very smart people that plan for these things so that if they do have investment years that give them extra income, or they have a particular thing that they want to subsidize in that particular year, they may take out a little bit more in one year than another, but it's all very highly planned. And that's one of the things, David, that you and I do for our clients, is we make sure that we build a proper financial plan so that we can show you exactly how much money you're able to take out without putting any of your financial future at risk. And some of the people that we've seen that aren't our clients that have come in, and we've seen some of the things that they've done, is that they've taken out more money than they really were able to. And then they've got themselves into financial trouble by not having enough income to be able to cover their current needs. And that's one of the biggest things and faults that we find in individual investors compared to institutional investors, is that they overspend what they have. They see something shiny, whether it's that new car or that bigger house or the vacation home, and they go out and they spend money without actually looking at how that might impact their financial future. And that's why we spend so much time, David, on building these plans so that we can look after our clients like the institutional investors do. And we make sure that their portfolios are diversified to ensure that they never run into any of these problems. The fifth point to consider is incorporating ESG and socially responsible investments into your portfolio.
That's right, Harry. Institutional investors for quite some time have been considering impact or sustainable investing. There definitely were early adopters to this compared to retail or individual investors. And part of the reason is because institutional investors may be investing on behalf of an endowment or a charity that may have very specific goals in mind of what they want their investments to support. So some institutional investors just naturally, their mission statement led them to be interested in more sustainable investment options. In other cases, some pension funds and just investors that are more interested in making a profit for their clients have looked at ESG or sustainable investments in recent decades because they've considered the risks of not factoring environmental, social, or governance issues into their investment process. In other words, they think that they're taking on unnecessary risk by investing in companies that are not sustainable, that are not doing the right things on behalf of their customers and also their shareholders. So in recent years, in the last 5 to 10 years, there's been a lot more adoption of sustainable investment from our clients and other retail individual investors as more and more demand for these products and more products come available in this space. And it's definitely something where institutional investors have seen the benefits of just as good returns, if not maybe a little bit better returns, with typically a little bit less volatility compared to mandates that don't consider ESG factors or sustainable investing at all. As always, if you have any questions, please don't hesitate to get into contact with Harry or I. We'd love to hear from you.
Take care.